accounting and give those people an insight into what you know. Likewise, you could be asked to advise a chief financial officer of a company or someone who's highly knowledgeable about accounting, what they need to know, or some alternative options on what they might need to do in a particular situation. So when you prepare for your exams at the end of this course, they're the kind of things I want you to put into your forefront. So today we're going to talk about corporate governance, and this is really a topic to bring most of the work that you've done, not only in your accounting program, but probably throughout your business course together. Because at the end of the day, there's a sort of triumvirate of issues that we're going to focus on. Now, I talked a little bit about those with you previously, but we see governance as a sort of central, or as a key part of that triumvirate of forces. So I'll just talk about the word, the idea behind governance initially, because governance, it doesn't only apply to corporations, it applies to a whole range of different types of organisations. And we talk about governance in public sector life, in not-for-profits and all that. So what do you think the key things are in governance? What are we going to look for? Any ideas? Someone says this organisation has good governance or this one has bad governance. What are some of the things that would distinguish one from another? Have you heard anybody talk about governance before? Is this a new word for you? Someone says this is bad governance. What are some of the things that might have happened?
Maybe it's a corporation organization is not led properly. I mean, people are not doing their jobs. They don't know what they need to do, what is expected from them. And leaders themselves, maybe they're not open to them. They don't say what they expect from them, and maybe something like that.
Okay,
like leading.
They're all good points. I'll just put them on the side here, by here. So you talked about leadership.
Yeah.
You also talked about communication in there.
Yeah, understanding your role in the company.
Understanding roles and things like that. So people knew what was going on, they all had their understanding. So they're all really important points that come out. So what are some other things that you might have, someone says there's bad governance in a company or a business or a government or whatever. Or alternatively, think about good. If someone says it's really good, what are they doing that's really good? How, you know?
Well, from accounting side, maybe you could look at those 4 forces that ESB identifies. You gotta be reliable, like your information must be understandable, comparable, you know. So you gotta do a good job and be a fair worker, because that's what accounting is all about. You got somebody else's money, but you treat it all fair.
What was that? Sorry, the last part again?
I said, I mean, accounting, that's the position where you got somebody else's money usually, and you gotta treat it all fair.
Okay, treat it fair,
Yeah.
and okay. I guess we talked about that as being integrity.
Exactly.
I'll put in here money management. So the accountant's involved with this kind of things, and so you know, when we talk about a breakdown in corporate governance, it often becomes symbolised because there's been a breakdown in money management, usually corruption.
Yeah.
So who's going to take the money? Most likely it's the senior executives of the company. And they're the people who are in a position to commit major fraud. So whenever we have a major corporate collapse or corporate financial crisis, it's often, you know, around this money management issue. That CEOs, CFOs or whatever have been able to create false or misleading information. The quality of information has not been good. They've been able to fool lots of people about what's going on. Maybe make false statements, induce further investments, make statements about the performance of the company that's misleading, have all that approved and checked off, and so there's been a fraud. So that's often the classic case of bad governance. It's epitomised by a breakdown here. But more systematically, it's all of these above. So this is where we can observe it, but it happens because of those things. So it's a bit like a person who gets sick. You've got a particular disease that you maybe contracted in some form. That's going to make you sick or make a company collapse. So we use that analogy. A company will become fatally wounded because it's lost all its money, then it'll get wound up. That's what kills the company off. But what caused that? Well, it could have been lifestyle. So if we use the health analogy, someone might be smoking and drinking and having a wild lifestyle, and that's going to ultimately cause the disease in the body that will kill you off. So likewise, if you have a reckless, poor management system at the top with poor leadership, poor communication, all of these things going on, that can become symptomatic and lead to money issues. So we can sort of observe these things happening in a number of corporate failures. Often the people who are most likely to end up running out of money for their company are executives who lead very flamboyant, creative lifestyles. Yeah. And we see a history of these kind of people. They have big parties, they get involved in sporting events, throw money around, they live a pretty entertaining lifestyle, the media loves them, these are all famous people. But in many cases, 5 or 10 years later, they've usually stuffed their companies up. Along the way, people have often been told things about how great the company is, and people just tend to believe it because these leaders are very charismatic people. Now that's happened over and over again right throughout history. We can go back to cases, you know, for the last 100 years or more, where business leaders have gone and entertained royalty and, you know, presidents and prime ministers and whatnot, build a great big empire, people all trust them, and then their empires or their corporate structures have collapsed. So what we're trying to do with good governance is, you know, make sure all of these things are in place, that we get good leaders, those leaders are accountable, and there's checks and balances. So when we're looking at a corporate governance or a governance system, there's a system of checks and balances. Now we can talk about that in a political sense, because governance is a more broader concept, but politically speaking, we talk about governance that gets out of balance when leaders, particularly we would call them maybe dictators or people like that, assume too much power. There's nothing else to counterbalance those leaders. And so, not that any political system is perfect, but in most democratic systems, there are usually senates and representative chambers, there may be presidents and prime ministers, there are different balancing positions of power within the political systems. So likewise, when we look at corporate structures, we look at usually a split leadership, where we can talk about a CEO and a chairperson of an organisation as being two separate people. But that's not always the case. Sometimes the two roles get combined. We get the CEO and chair being the one person. Again, that is seen as being risky. So good corporate governance will make sure we've got two people, at least two people at the top to balance each other out. And we see that, as I said, in political systems. Most political systems in Australia, we have a Governor-General and we have a Prime Minister. to notionally balance those conflicts of interest out. And in other countries we have presidents or senators or various other groups to run those sort of balances. Communication is really an essential part of good corporate governance. People need to know what's going on. That builds trust. People have confidence. But what are we communicating? We need to make sure that information is reliable, that it's checked off, we've got quality of the information. So we're going to need to look at how do we design systems of corporate governance to give us the best type of information. Now that's where our accounting standards come in, our auditing standards. But when we look at corporate governance, it's not just the standard, it's how we implement that standard. What are the steps that are in place there? And through leadership and through good communication, we'll have both internal and external stakeholders in the organisation. So all the different people and groups or committees or structures that are put up need to have clear roles, need to have clear statements of their duties and their responsibilities, so they all get counterbalanced. And the outcome of all of these sorts of things is that we should have minimised the opportunity for mismanagement. So we talked about the agency problem, conflicts there. We know there are inherent conflicts in any organisation. There are lots of people, and we assume that most people are going to act in their own self-interest. So there's always going to be a temptation for people to mismanage, or if there's opportunities, to access other people's money. Now that can be done in obviously fairly sophisticated ways. It's not, doesn't mean you go out with your dark glasses on and rob the bank and take all the money out. When a CEO or an executive might be accessing that money, that could be through their share, through their executive remuneration or payments. They pay themselves more money. So how do we control the executive remuneration? We saw, and I talked to you last time about regulation, particularly about some of these issues. And most of the research that we're looking at now shows that after the global financial crisis, one of the contributing factors that people said was many executives had contracts for their remuneration that incentivised them to take greater and greater risk. So they were, more or less, particularly in the banking and finance industries, gambling, that they were gambling with the shareholders' money to leverage up the returns because they would be paid bonuses based on those returns. And we know that the salaries of and bonuses of the major bankers were usually in the tens, sometimes hundreds of millions of dollars per year, and in a few cases were even more than $1 billion a year. So people were being individual executives were being paid huge amounts of money to gamble and incentivise themselves using the financial resources. So it wasn't just straight out stealing, although that has happened in the past, but modern corporate corruption, or in a sense, is usually linked to incentive structures. So good governance is going to sort of try and control the executive remuneration and compensation. That's going to be a key part of an organisation's corporate governance system. Now, the latest data that we've seen is that although the incentives for executives dropped significantly in 2008 after the 2007 financial crisis, by 2011, certainly to end of 2010, 2011, we know that many of the top fund managers now are earning incomes back above what they were. So that dip in executive compensation only happened for a few years. So the top hedge fund managers last year globally were earning personally $5 billion plus US dollars. So huge amounts of income still going to senior executives in the finance industry. And that raises a lot of questions about the long-term sustainability of the financial systems, particularly our banking and finance systems globally, where more and more of the shareholders' resources are being devoted to the executive management compensation. Now, what we want to do is build on this governance, and I talked about a triumvirate of elements, and basically what we want out of good governance, and good governance is going to do two things. One, it's going to enable the organisation to look forward, and the other one's going to be basically the backward-looking step, which is your reporting and your reward systems. So we've got two things two elements that feed off this. And that's performance and strategy. They're the two, those three things together, in my view, are the core elements of any organisation's systems and operations. Everything else really underpins and falls off these things. So governance is, what we're going to do is concentrate on that, but we need to keep this in mind. Who sets the strategy for any organisation, which is your forward-looking direction, is the board of directors. The chairman or chairperson of a company will be strategising and working with consultants and others to understand their industry, their risks, their environment, etc., to build a corporate strategy, to position their entity, to set the risk profile for the business, etc. So we'll look at that, and then what we've got then is a governance system that's going to monitor and manage the performance of the business. So this is what actually gets done, and to make sure that's all heading in that direction of that strategy. Now these things then, we'll move this around in a circular fashion, constantly moving. So corporate strategy, not something that's written and stuck in a cupboard and pulled out every 12 months and how's it going. It's a living thing. Corporate governance is dynamic and living. It's constantly responding to challenges. And corporate performance is again one of these things that's going to be constantly reviewed. So we're going to look at those sorts of dimensions. So we can look at this, and I use an acronym here, GPS. We sort of play on those words, global positioning system, but that's what it is. So you can remember it: governance, performance, strategy. They're the building blocks for any good business, and you get business governance system. They're the things that are going to be the building blocks for making it happen. So what we want to do is really now go through and look at all these things. What are the checks and balances that we have in place? How do we define governance? How do we define performance? How do we measure performance? What are the different rules that we've got? How do we assure that the performance that we are measuring is correct, is not being manipulated by management, or minimise that manipulation? And then look at the strategic positioning of companies and where they're trying to head. So that's going to be in terms of their risk, predominantly their risk profiles position, their position within a market, what kind of, whether they're a leader in a market, price leader, price taker, innovator. There's a lot of strategic issues around strategy and corporate positioning, and then how that is built then back through the governance system, because the positioning will influence the kinds of people who will get involved in the governance. So keep in mind that governance is going to involve not just the direct participants like shareholders, but a whole range of other indirect participants in organisations, such as community groups, social groups, a whole range of things. And we see constantly a lot of debate, and you've talked about some of those in environmental, social reporting issues, the ESG type stuff. So we talk about environmental, social issues. Now, all of those things also tie back into strategy performance. What are we going to reward our executives for? What are the key variables and drivers? Now, that could be based on actual performance through production or sales or some sort of market share, but it also could be involved on some strategic dimensions, such as being able to eliminate or take over competitors in your industry, or to vertically integrate your corporation. So we know some CEOs in some organisations, particularly the CEOs, get rewarded on their ability to move their company through strategic profiles, and that's going to be their core performance goal. It's not necessarily production or sales, but through leveraging their assets and then being able to acquire other businesses. So some companies become quite aggressive takeover operators. So that's a sort of broad picture of what we're going to look at. We'll have a quick look at, just move on to the second slide. So we've talked significantly about giving you some ideas about corporate governance and some of the issues there. As I said, I want you to be able to think in your own minds clearly about what is good corporate governance, what are the characteristics. So if you came into a business, you would be able to say these are the things that a business should be able to identify and have if it's got a good system of corporate governance. Now, there's a lot of fine-tuning in all of that, and a lot of issues. So then we'll have a look at the OECD principles of corporate governance, the Organisation for Economic Cooperation and Development, and then I want to look at some of these core parts of corporate governance, particularly what directors and boards of directors do, and then look at the roles of different types of directors, executive, non-executive, the role of the audit committee, and the remuneration committee, board and executive remuneration. Now, these are all areas, these last four, that have all gone under a lot of reform in the last 10 or 20 years globally. Now, we can see there's a couple of dimensions here. One is that in the last few decades, the growth of the corporation has really been widespread or ubiquitous around the world, but many governments and countries didn't have rules and regulations for corporate governance. So this is where the OECD has become involved, as well as groups like the IMF, the World Bank and others. The OECD principles are seen as sort of the starting point for good corporate governance. Now, good corporate governance assumes that there is a pretty strong infrastructure within a country to support corporate development. So that means that you've got a well-developed accounting profession with auditors, accounting education, lots of opportunities for experience and training. You've got a strong audit profession with a lot of education and training and development around auditors. You've got good legal systems, independent judiciary, that you've got a government agencies or regulatory agencies, and we talked about those when we looked at regulations such as ASIC or the Securities Exchange Commission in the US and groups like that are going to monitor and manage the regulatory environment, that you have a well-developed pool of independent or non-executive directors who are not tied up with companies. So when we look at all of these principles and start to think about all the things that you need under an OECD principle to get this kind of outcome, you're really looking at a well-developed economy, a modern developed economy. So one of the big challenges has been in emerging markets, particularly newly emerging and developing economies in Asia, Africa, South and Central America. A lot of these things are missing or are only very recently developed, even in Eastern Europe and places like that. So a lot of resources are being spent by, through the World Bank, through IMF and other groups, trying to promote the development of the institutions that enable good corporate governance to exist. Why do the developed world countries want this to happen? Predominantly, it enables investors in developed economies to have confidence in the investments they may be making in emerging markets. And we know that when we look at the global investment trends, and you know, many of the developed economies in even more recent times, following the GFC, have flat, or in many cases declining economic growth in Europe, North America, etc. So where are the major investment opportunities? They have, and they're going to be more likely in the emerging and developing economies. The economic growth of many of those economies, China, India, others, has been 6, 7, 8, 9, 10% or more per year. Some are even higher. So investors from the developed world are making major investments in these economies. They've been pressuring these countries for improved corporate governance. So we've seen this global pressure evolve. Now, it's, in my view, again, a sort of form of neo-imperialism, that a lot of these ideas happens every time, doesn't it?
Yeah.
Well, you've done it twice, but it's 100%.